Director of Research there, and we spoke with him about making an occasional tune-up on your portfolio. Mr. Goldman, hello. Where are you?
How are you?
I'm doing fine. Where are you, sir?
I'm actually right now. I'm in El Segundo.
Where exactly is El Segundo vis-a-vis L.A.?
Oh, sure. We're about a mile from LAX. We're probably west of LA.
Okay. All right. Well, nice to have you on board here. Before we go any further, tell me about Cetera. Tell me about Cetera Investment Management. What do you do?
So we're a division within Cetera Financial Group. So Cetera Financial has 8,000 advisors all over the country, working with hundreds and thousands of clients. We have my team. We're the internal investment research team. So we do market strategy, we do portfolio construction, investment recommendations that our advisors use with their clients.
Okay, swell. I'm an investor myself. I have various investment vehicles. I invest in stocks and mutual funds and things like that. So I know these questions. I mean, they seem kind of routine to me, but for somebody who doesn't maybe dabble in as much, maybe it's this is kind of foreign. But why should an investor check up on their portfolio every so often?
Oh, it's great because you should always check up your portfolio because things change, and especially right now is a good time because we are in the longest economic expansion since 1854. We're in the longest bull market ever. All this is great news. So good times are rolling, but you always have to look for unexpected consequences. So we're stressing to our advisors and their clients that while things are going really well, as market volatility is picking up, look at your portfolio. Make sure that you're locked into your longer-term investment objective. We see portfolios that are a little skewed to too much risk. Case in point, if you were a 60-40 investor coming out of the Great Recession, so basically 60% stocks, 40% fixed income, just by doing nothing, your portfolio today is 83% stocks and 17% bonds. You've, in essence, moved to a more aggressive investment objective by doing nothing, and this is what worries us right now.
Then let's get to it. How often should somebody do this and kind of look over their portfolio and rebalance it? Should that be done semi-annually, quarterly, annually? How often?
Sure. If you take me as an example, I'm the wrong person to ask because I'm an engineer by trade, and so for me, I'm always looking at my portfolio, my account, constantly. But from a realistic standpoint, ideally once a quarter. Once you get your quarterly statement, review it, look at your investments, understand why you have that position, and then definitely sit down with your financial advisor once a year and do a face-to-face meeting and understand each of your investments, how they're performing, are there better investments out there, and just sit down with your advisor. And then, of course, in that annual face-to-face meeting, really use the opportunity to really tell your advisor, are things changing? Has anything changed in your life in terms of, you want to retire or you want to start saving more money or anything that's changed? Your kids are getting ready to go to college. Use that as an opportunity to update your financial situation.
Interesting you mentioned about how a portfolio can change in 10 years, from the recession until now, 60-40 turns into 83-17. I, years ago, gave a check from my 401k, which had cashed out, to my broker. And I said, here, do something with this. And she put me into 9 different funds. And I set it and forget it. I would look at it and see how it was doing. The funds were doing well. But then one day I said, I really should take a look at these funds and see what I'm in. And I checked the top 10 holdings of all of these funds, and a lot of them were the same. Had become the same over time, had kind of almost morphed into one fund if you get right down to it. And so I said to my current broker, I said, maybe we should change this up a little bit. And we whittled the 9 funds down to 4 funds. And so that, I guess that's a textbook example of why you should do that every so often, because things can change and you don't know it.
Yeah, and that's perfect. You asked the right question. Just like when you go to your doctor and your doctor prescribe some medicine for you, you're going to ask, why this medicine? Why do you think this will work? Just like with you and your broker and your advisor sitting across from them and saying, why are we in this investment? Let's change it. Let's give me some perspective behind this investment. Same thing when you see your doctor.
Mm-hmm. Right. Where do you think markets are going? Because, I mean, you mentioned volatility. I mean, like, as we record this last week, we were down 800 points. We were up 300 points. We were down another 200. It seemed like it was a roller coaster. And it seems like it's not, this roller coaster isn't ending anytime soon. Where do you think it's going?
No. So it feels like we're in a big roller coaster, but keep in mind, though, that we've been in a period of very low volatility for a very long time. On average, the stock market moves up or down 1% about 25% of the time, about 1 out of every 4 business days. But lately, we've seen it come down to maybe about 10 to 15% of the time. So 1 out of 10 or 1 out of 7 business days. So volatility has been very low. Volatility will continue to pick up dramatically because, there's some concerns that we are near the end of the economic cycle. There's some concerns about the China trade war with the U.S., concerns about the Fed. But when you take all this information, this creates uncertainty, and this creates more market volatility. To your question, our perspective for the rest of the year and next year, we truly we're cautiously optimistic about the markets and about the economy. On the positive side, we see 3 things driving the markets. Number 1, the trade war will be resolved soon. That's our opinion. There's many reasons why, given the effect on the stock markets, given the effect on the economy. Think about this. In the U.S., we see weakness in manufacturing. But in China has had a 27-year low in GDP, 27-year low. So the trade war is definitely affecting their economy. The second thing, as I mentioned, the stock market. The third thing is important, is the demographics in China. China has a very aging population. And because of this, the aging population, for example, lowest birth rate last year since 1961. Aging demographics, China does not have the social infrastructure to take care of an aging population. That's why they're trying to convert their economy to a manufacturing-based economy, or from a manufacturing base to a consumer-based. And by doing this, the trade war is really interfering with this right now. So our positiveness is trade war gets resolved soon. The Fed, number 2, the Fed is on our side. They're cutting interest rates, which is good for your listeners in terms of credit cards and mortgage rates. And the third thing is the data on the consumer side is very strong. Consumer spending is strong. Consumer confidence is still very strong. So consumer, a 50-year low in unemployment. So we're cautiously optimistic for those 3 reasons.
Gene, let me ask you about trade war real quick here. You say it's going to be resolved soon.
Yes.
Who will come out the better of that? Yes. When it is resolved? Will we quote unquote win the trade war?
That's a great question. So I think both sides are going to claim they won the trade war because both sides right now, the rhetoric is increasing because both sides want to save face and both sides want to be, again, say, hey, we did a great job, we solved this trade war, or we came out on top. And from my perspective, I think the U.S. will win. I mean, there's so many reasons why. You look at the global economies right now. The U.S. is one of the strongest global economies right now. We can withstand this short-term weakness. You look at Germany. Germany's GDP just came out for the second quarter. It was negative. And then you look at German business confidence. It's at a 7-year low. So you're seeing this throughout the world. On the other hand, the U.S. continues to be very strong given our consumer side, given our services side. And China is really, they announced more stimulus this morning. They continue to announce stimulus to stimulate the economy, but they are worried. Chinese unemployment in cities is at its highest level ever. Industrial production is at its lowest level since 2000. All these data factors continue to suggest that this trade war is really affecting China. And this is why we saw rhetoric increase dramatically on the Chinese side just over last weekend.
Gene, I've got just a couple minutes left with you here. If you're cautiously optimistic, then turn that into an action plan for investors. What should we be doing and how should we be playing this?
Yeah, I think right now, if you look at this, I would look, as we talked about this, look at your portfolio because yes, while we are cautiously optimistic, things can change on a dime. Unexpected occurrences can definitely happen. So our game plan for our advisors and our investors today is 3 things. Number 1, look to make sure you're rebalanced back to your long-term investment objectives. Right? And I talked about this before because again, some of our portfolios have gone a little skewed, a little too risky. Number 2, on your equity risk exposure, be more diversified. So what I mean by that is, right now we all love growth stocks. We love growth. And I talked about this earlier. We love growth stocks, but value is attractive. Value stocks. Think about this: year to date, growth is up about 20%. Value stocks are only up about 10%. So value stocks are looking attractive. International stocks look attractive. Also look at alternative investments. These are investments that tend to zig when the markets zag. And the third thing for your portfolio is look at the fixed income exposure. So the bond exposure. Bonds should be your safe money. It should not be your aggressive area. It's your safe money. But over the last few years, the last almost decade, we've got super low interest rates. So investors have been going in and buying more aggressive, higher yielding securities, which makes sense. They did very well. But now these securities look and act and feel like equities based on their characteristics. Now if the markets pull back, these securities that are embedded in your safe money are going to go down with it. So we would definitely look to rebalance out of high yield into more conservative, safer bonds.
There we go. Gene, they're going to give me the hook here. Where do we find out more about all this? Where can we go?
Sure. Two areas. Number one, we have a website, Cetera.com, CETERA.com. That's our firm's website. And then for constant market perspectives, you can follow us on Twitter. It's Cetera IM for investment management. Cetera and the letter I for Ida and the letter M for management.
Cetera IM on Twitter. There we go. Gene Goldman, I thank you for some time out. Best to you in El Segundo. Great.
Thank you, Ken.
Gene Goldman, CFA, Chief Investment Officer and Director of Research with Cetera Investment Management. I should come with a disclaimer here that his viewpoints and opinions are not necessarily those of yours truly or of anybody else connected with this podcast, and you should make your own investment decisions in conjunction and consultation with your own financial advisors. So keep that in mind. And that is 30 for this edition of Conversation Collage. Appreciate you being with us. If you're listening to this in the Labor Day holiday, enjoy. Take some time off. Be with your family, recharge, and get ready because we're about ready to get back into the full swing of things, aren't we? And catch us again next time for another edition of Conversation Collage. Ken Johannesson here. See you next time. Be good to yourself.